Welcome to Griffonomics. Today's deep dive is custom tailored to explore Century communities, trading under the ticker CCS. We've um, we've pulled together this really dense stack of their Q1 2026 SEC filings.
Yeah, specifically the Form 8K and the proxy statement DEF 14A, plus a ton of earnings call transcripts and strategic reports.
Right, which is just a massive amount of material to sift through for you. But our mission for you today is to generate a granular strategic report and an investment roadmap out of all that data.
Exactly, because when you align those filings with the calls, it really paints this detailed picture of a company navigating a deeply turbulent macro environment right now.
Yeah, and they're making some highly counterintuitive choices to survive it. So we're going to analyze Century's affordable spec model to understand its resilience in the entry-level housing market.
Right.
We'll be specifically unpacking their recent 5% guidance reduction, a massive 27% discount to book value, and this rather stark regional divergence in their sales. Okay, let's unpack this. Before we dive into this choppy macroeconomic waters of Q1 2026, we first need to understand how Century Communities actually builds and sells homes.
Yeah, because their operational model isn't just some background detail,
Yeah.
It is the foundational moat of their entire business.
Right.
And that moat is built almost entirely on what the industry calls speculative or spec building. Century is operating on this incredibly high 98% spec-driven production model across the whole company.
Wait, 98%?
Yeah, 98%. And if you look at their Century Complete brand specifically, it's literally 100% spec builds.
Wow.
They don't wait for a buyer to ask for a house. They just start pouring foundations and building homes based on what they know will sell.
I always like to think of this like buying a suit, you know? The traditional home building model is like getting a custom tailored suit. You pick the fabric, the buttons, the lining.
And it takes months.
Right. There are always delays because your specific buttons are out of stock, the price creeps up, and by the end, you're just exhausted.
Yeah.
Century's spec model is like buying a really high-quality, off-the-rack suit. It's already built, it's faster, it's cheaper, and you lock in the exact price today, you walk into the showroom and buy it.
What's fascinating here is why that spec model matters so much right now in 2026. Because the home is already finished or, very close to it, buyers can lock in their mortgage rates quickly.
Which is huge right now.
It's massive. They get certainty of financing. In a volatile rate environment where mortgage rates are bouncing around every single week, telling a buyer, hey, you can close in 30 days and lock this rate right now, that is a massive competitive advantage.
Especially compared to a builder telling a buyer to wait 6 months and roll the dice on whatever the rate will be then.
Yeah.
Let me jump in on the logistics of that, actually, because it streamlines their supply chain tremendously.
Oh, absolutely.
By not having to customize every single home, they've improved their cycle times.
The time from pouring the foundation to handing over the keys.
Right. They've improved that by an impressive 15%. They are down to just 114 calendar days. A year ago, that was 134 days.
Which is almost 3 full weeks shaved off the build time.
And they achieved that simply by ordering the exact same lumber packages, the same windows and appliances in bulk. They aren't waiting for, like, a custom Italian tile order to clear customs.
Yeah, and turning that capital over faster is the engine of the business. They buy the land, build the house, sell the house, and reinvest that cash much quicker than a custom builder. And they use that efficiency to protect their affordability moat.
Because they have a laser focus on the entry-level buyer.
Exactly.
Yeah.
In the first quarter of 2026, a staggering 96% of their home deliveries were priced below Federal Housing Administration, or FHA, mortgage limits.
That is the real key for you to understand their target demographic. Their average sales price in Q1 was $364,700. When you compare that to national averages, which are well over $500,000 for a new home right now, they're offering a highly accessible product. They're basically the gateway drug to American homeownership.
Yeah. And there's a structural undersupply of affordable entry-level homes in the U.S.
Yeah.
The 2008 financial crisis wiped out a decade of home building, and the industry just never fully caught up in this specific price tier.
So Century has positioned themselves directly in that permanent sweet spot.
They really have.
But because they build those off-the-rack homes so fast, you'd think they'd be completely immune to market bumps. But looking at the financial realities of Q1 2026, we see exactly where that armor dented.
Yeah, the top line numbers were a bit rough.
Total revenue hit $789.7 million. Now, that was a miss of roughly $6 million against Wall Street expectations. And we saw an 11.9% year-over-year decline in total home deliveries.
Dropping down to just over 2,000 units.
Right, 2013 units. Missing revenue and dropping volume by nearly 12% sounds like a glaring red flag for any business.
It looks like a red flag until you dig into the margins. When demand slowed down, Century had a decision to make. They could have slashed their sticker prices to maintain their sales pace and keep moving high volumes.
But they didn't.
No, they didn't. Instead, they made a deliberate strategic choice to preserve their margins. They accepted a lower volume of sales to keep the profitability of each individual home exceptionally high.
Okay, here's where it gets really interesting. How does a company deliver almost 12% fewer homes but still manage to squeeze out significantly higher profit margins?
It's pretty wild.
Looking at the filings, their adjusted home building gross margins actually increased sequentially by 140 basis points, so nearly a 1.5% jump, reaching a very robust 19.7%. That defies basic supply and demand logic.
Well, two major factors drive that margin expansion. First, they saw a $13,000 average drop in direct construction costs per start. Lumber, basic materials, and labor bottlenecks eased up, allowing them to build the homes cheaper. And second, they absolutely refused to broadly slash the final sales price of the homes.
Wait, if you aren't cutting the price of the home, how are you getting these entry-level, highly sensitive buyers into the house when interest rates are hovering at these elevated levels?
That's the trick.
Yeah. A buyer who can afford a $360,000 house at a 4% rate usually gets priced out completely when rates jump.
This brings us to the hidden mechanics of modern home building, specifically their in-house financial services arm. Instead of cutting the sticker price of the house by, say, $20,000 to attract a buyer, they use concessions to buy down the mortgage rate for the buyer.
Oh, I see.
And specifically in Q1, we saw a massive strategic pivot toward adjustable rate mortgages, or ARMs. ARMs accounted for roughly 30% of their mortgage originations by principal volume.
Wow.
To put that in perspective, a year ago, ARMs were under 5% of their originations.
Okay, let's pause and explain the why behind that strategy for you listening. Why spend cash to buy down a buyer's mortgage rate instead of just dropping the price of the house by the same dollar amount? To the builder's bottom line, it costs the same, right?
It costs the same in cash, yeah, but it completely alters the balance sheet of the neighborhood.
How so?
Well, if a builder drops the final sales price of a home by $20,000, they permanently destroy the appraisal value, or the comps, for every other home they're trying to sell in that development.
Right. Future buyers and banks will see that lower price and demand it.
Exactly. But by paying the bank up front to temporarily lower the buyer's interest rate, the official sticker price of the home stays high. The comps remain pristine, the entire neighborhood retains its asset value, and the buyer still gets the lower monthly payment they desperately need today.
That is brilliant. So nearly a third of their buyers are using ARMs now, relying on lower initial rates to bridge the affordability gap, while Century protects that 19.7% margin.
It's a great way to hide a discount.
It really is. But while those backward-looking margins held incredibly strong, the earnings call transcript paints a much more concerning picture about forward-looking demand. They had a strategic inflection point right around March.
Yeah, they did.
And it revealed a sharp regional divide that you must monitor if you are tracking this sector.
The drop-off in March demand was severe enough that management actually issued a macro guidance cut. They reduced their full-year 2026 home delivery guidance by 5%.
Down to what?
They are now projecting between 9,500 and 10,500 homes, and they walked back their revenue expectations to a range of $3.5 billion to $3.8 billion.
The reasons management explicitly cited for this March slump are what caught my eye. They pointed to the conflict in the Middle East, higher interest rates, rising gas prices, and weakening consumer confidence.
Yeah, it's a heavy list.
Now, let me push back on this naturally. I totally get interest rates scaring buyers away. But why on earth is a home buyer in Denver or like a young couple in the Bay Area suddenly canceling their house contract because of a spike in gas prices or a geopolitical conflict in the Middle East? Are modern home buyers really that fragile?
If we connect this to the bigger picture, it is entirely about consumer psychology and the compounding weight of inflation. It's not just the extra 20 or 30 bucks it costs to fill up the gas tank.
Right.
It's the signaling. You have sticky inflation making groceries unaffordable, the Federal Reserve signaling that rates might stay higher for longer, and a constant anxiety-inducing news cycle about global conflicts.
It all just piles up.
Exactly. Buying a home is the largest, most highly leveraged financial decision of a person's life. When the macro environment feels completely unstable and everyday costs are inching up, consumer paralysis sets in. They decide the safest bet is simply to pause.
They just sit on their hands and wait to see if the sky actually falls.
Yeah. Though we did see that paralysis thaw out a bit. Management noted that April showed a rebound with sequential and year-over-year order improvements compared to that severe March slump.
So the shock wore off.
The shock wore off, but the damage to the first quarter was already done.
And if you are an investor looking at their geographic footprint, that damage was absolutely not distributed equally. The regional bifurcation in their data is wild.
It really is night and day.
The Southeast region was their absolute strongest market. Nashville, in particular, performed exceptionally well. In fact, the Southeast was the only region where deliveries actually grew year over year, up 4%.
Contrast that with the West region, which was a disaster by comparison. The West was their weakest market, heavily dragged down by the Bay Area, resulting in a 14.3% drop in net new contracts.
Why such a massive split? Are we just seeing two completely different economies operating simultaneously in America?
In many ways, yes. The West Coast, particularly the Bay Area, is highly sensitive to tech sector volatility, layoffs, and a baseline cost of living that is already stretched to the breaking point. Even entry-level homes there require massive leverage.
Right.
In contrast, the Southeast is still benefiting from structural migration. People and businesses are moving to places like Nashville for lower taxes and better affordability. Century's national footprint.
Operating in, what, 16 states?
Yep, 16 states and over 45 markets. It means the boom in the Southeast is actively absorbing the macroeconomic shocks echoing out of the West.
But because of this macro volatility, the lowered guidance, the regional weakness, the broader market has grown very skeptical of Century. If you look at the bearish metrics, their backlog value dropped nearly 16% year over year, down to $438.5 million.
Yeah.
Net new contracts fell 11.6%, and analysts are pointing to looming risks of fuel and petroleum price inflation. If fuel goes up, the cost to move dirt, transport lumber, and rent equipment goes up, potentially crushing construction costs in the second half of 2026.
The market skepticism is loud right now, for sure. But when you evaluate a business, you have to look past the market sentiment and examine what management is actually doing with their capital. Words are cheap on earnings calls, but capital allocation signals immense internal truth.
And their internal actions signal massive confidence.
Exactly.
Let's start with inventory forensics. They aren't just sitting back hoping the macro environment improves. They are actively cutting their risk exposure on the ground.
They drastically reduced their finished spec inventory by 31% year over year. They ended the first quarter with less than 3 finished specs per community.
Meaning they don't have millions of dollars tied up in empty unsold houses sitting on empty lots, slowly bleeding property taxes and maintenance costs.
Exactly.
They are keeping their inventory incredibly tight to match the slower demand.
But the loudest signal of all is what they are doing with their surplus cash, the share buyback program. In Q1, they repurchased roughly 617,000 shares for $40 million at an average price hovering around 64.80.
Which is a stunning 27% discount to their first quarter book value of 88.75 per share. Let's break down book value. So the genius of this move is crystal clear for you.
Good idea.
Book value is basically what the company would be worth if you stopped operations today, liquidated all the land, sold all the lumber, paid off all the framing contractors and the banks, and distributed the leftover cash to the shareholders.
Right.
That math says the company is intrinsically worth almost $89 a share, yet the public market was pricing the stock at $64.
So when management buys back their own stock at a 27% discount to that liquidation value, it is a definitive floor-setting move. They are loudly telling the market, you have priced our business incorrectly, and we will happily take advantage of your mispricing to create value for ourselves and our remaining shareholders.
It is essentially a real estate flip, but executed on their own company. Imagine Century Communities looked out at the entire U.S. housing market, analyzed all the raw land, all the new development opportunities in 16 states, and realized that their very own stock trading for 73 cents on the dollar was the absolute best, most profitable investment they could possibly make.
Yeah, exactly.
Why buy a new plot of land in Denver when you can buy your own highly profitable company at a massive discount?
And they signaled further confidence in their forward-looking cash flow by having the board approve a 10% hike to their quarterly cash dividend. Even with the macro headwinds, they're generating enough cash to reward the investors who stick around.
We also have to touch on the corporate governance restructuring detailed in the proxy statement, because there is a major leadership pivot happening here that ties directly into shareholder alignment.
Right. Effective earlier this year, they eliminated their co-CEO structure.
Which is always an interesting move.
Yeah. Robert J. Francescon has taken over as the sole chief executive officer and president, while his co-founder, Dale Francescon, has transitioned to executive chairman.
And alongside that leadership transition, they significantly tightened their internal rules regarding stock ownership. They raised the target stock ownership guidelines for the CEO and executive chairman from 6 times their base salary to an incredible 10 times their base salary.
Holding 10 times your base salary in company stock is serious skin in the game.
It's the corporate equivalent of a captain legally chaining themselves to the ship's wheel. If the ship goes down, they go down with it.
It ensures that the people making the highest level capital allocation decisions feel the exact same pain or reap the exact same rewards as the everyday retail shareholder. The alignment of long-term interest is incredibly strong here.
So what does this all mean? We've pulled all the threads together. We've looked at the highly efficient 98% spec model and how it protects margins by locking in financing. We've examined the macro fears causing the guidance cuts, the psychology behind the March demand knife, and the stark regional slowdowns in the West compared to the Southeast. And we've seen management's response through deep value share buybacks at a 27% discount to book value.
When you synthesize all of these competing forces, the final verdict for the strategic outlook is clear. Accumulate on weakness.
I am intrigued by that verdict. You believe the internal strengths outweigh the macro risks.
The cyclical volatility is very real. The March slump in orders was real, and the inflation risks in the back half of 2026 are real. But as an investor, you have to zoom out. This is a company with 23 consecutive years of profitability.
That's a long time.
Right. They have survived the dot-com bust, the 2008 great financial crisis, the pandemic supply chain collapse, and the unprecedented recent interest rate hikes. Through all of those catastrophic events, they have remained profitable.
And let's not forget, their balance sheet is an absolute fortress right now. They are sitting on $886 million in total liquidity. And perhaps most importantly for navigating a high-rate environment, they have absolutely no senior debt maturities until 2029.
That's massive.
They have years of runway before they even have to think about refinancing major debt at these higher punitive rates.
That financial fortress makes Century Communities a true value and yield play. You are getting an incredibly well-capitalized builder focused on the most structurally resilient demographic, the entry-level buyer.
Exactly.
You are acquiring it at a massive discount to its actual intrinsic book value, and management is paying you a growing dividend simply to wait out the macro storm.
It is a highly compelling roadmap, but it leaves me with one final, somewhat provocative thought for you to ponder. We have talked a lot about macroeconomic volatility, supply chain constraints, and sticky inflation keeping rates high.
Yeah.
If those factors aren't just a passing phase, if high costs and volatility become a permanent reality of the modern American economy, will Century's highly engineered, mass-produced, spec-only model become the only viable way the bottom 50% of earners can ever achieve homeownership in America?
Wow.
If the era of the affordable, customized home is truly dead, builders like Century might not just be a good investment. They might be an absolute societal necessity. Risk-defined, portfolio protected,